Alrighty. So in today's video, I'm going to be sharing with you the ultimate bear call spread trading strategy where you can have more than 70% win rate. Now, in my previous video, I've already talked about its counterpart, which is the bull put spread trading strategy. If you haven't watched that, please go ahead and watch that first. I'll put the link at the top right hand corner of this video. Alright, so for this video, the bear call spread, let's get started. So what is the bear call spread? So the bear call spread, also known as the short call spread, what it is a bearish option trading strategy. That means you want the market to go down, and this is where your risk is defined. So this is unlike the naked options where you have a single option and your risk is unlimited. So with the bear call spread, basically you have a defined risk. So there's no way you can blow up your whole account in just a single trade compared to a naked put option or a naked call option in that case. So what it consists of is two single options, right? So you have the short call option that is usually out of the money, right? Or at least I like to place it out of money. And then you have the long call option where you buy back a call option that is further out of the money. So this way you define the risk to the maximum of this spread. So for example, the market is going down. As you can see, it's making lower highs, lower lows. And as it's coming up, let's say for example you think the market is going to go down, so you have a bearish outlook on this. So what you want to do is you want to sell a call option here, and then you buy back a call option that is further out of the money. So this way your risk is defined to the maximum of this spread width minus the credit which you receive. So your risk is defined to the width of the spread minus the credit received. So for example, if you have a 5-point wide bear call spread, so let's say it's 195, and you receive a credit of $1.50, so your max risk on this trade is $5 minus $1.50, which is $3.50. So that means per spread, that means you have a contract per spread that is a $350 maximum loss, right? So let's say for example you want to risk more, you will go for 2 contracts or 3 contracts according to your risk per trade. All right, so in this case you can see that the amount which you make is actually much lesser than your loss. So you might be wondering, how is it possible that you can make money on this? Because each time you lose more than 2 times what you make, right? If you win 2 times, you make $3. One loss, you're going to wipe up everything, plus you have a 50 cents loss. So how is it possible that you can win in the long run, right? So how can you be profitable in the long run? So the key here is that you need a high win rate to generate what you call a positive expectancy in the long run. So this is the key word. All right, so if on average you are making $1.50 when you win and you're losing $3.50 when you lose, then to have a positive expectancy in the long run, you need to win more than 70% of the time. So this is how you can create a winning trading strategy for yourself. So it doesn't matter whether you are making $1.50 or lesser. What you need to compensate for this low win amount compared to your loss amount is you need a higher win rate. So there is a formula that you can use to calculate your expectancy, right? So this expectancy, the way you calculate it is pretty simple, right? Basically you take your win rate times the profit which you make when you make the money on the trade minus the loss rate times the loss. So this will give you a number. If it's a positive number, it means your trading strategy is a winning trading strategy over the long run. And if yours is a losing number, is a negative number, that means it's a losing strategy over the long run. So the key down here is that you need a large sample size. You need at least 100 or more trades to be able to define what your expectancy is, right? So for you to have a positive expectancy, let's say on this number, which let's say you're averaging $1.50. So what you do $1.50 down here, you times 71%, and then let's say your loss rate is 29% times $3.50. You can see that you actually get a positive 5 cents on this trading strategy. So what it means is that on average, you make $5 profit per trade, right? You may lose 3 trades, then you win 8 trades, and there will be a number of winners and losers. Now over a large sample size, let's say of over 100 to even 1,000 trades, you're going to notice that you're going to have this kind of number. If you have this number, it means that in the long run you're going to be profitable. So the question comes down to, how do you exactly put the odds in your favor to ensure a positive expectancy, right? We know we need to win 70% of the time. So how do we actually achieve this number, right? And the answer is to have three key criteria to put the odds in our favor. So the first criteria of which is to, first of all, you want to wait until the market is overbought, right? So how do you know whether the market is overbought? You can use indicators such as the stochastic oscillator or the RSI indicator. Now, these are just indicators to tell you the condition of the market, right? It tells you whether the market is overbought or oversold. If you're not very familiar of the stochastic oscillator, I've actually already created a video on this. You can go ahead and watch the video I've created. I'll put a link at the top right hand corner of this video. You can go ahead and watch that, as well as the settings that I use to identify whether the market is overbought or oversold. So basically, with such kind of indicator, you will notice that there are two lines on these indicators. One will mark normally either 70 or 80. So in this case, I'm using the stochastics. I'll mark it as 80 and then 20 line below. So what it means is that, you know, there'll be this line that tells you whether the market is overbought or oversold. If it goes up, it means that the market is overbought, and then if it comes back down below the 20, that means the market is oversold. So what we are looking for down here is this for this line to cross above the 80 mark. That means the market is overbought. So why do we want to wait until the market is overbought before we initiate a bear call spread? Well, the reason is because there is a higher probability of the market going down when the market is in an overbought condition compared to an oversold or neutral conditions, right? So this indicator down here tells you at all times where the market condition roughly is at, right? So if you see that the market is overbought, and then when you see the market is at a neutral point, and then the market is oversold. Now, if you want a bearish trade to put on, you want to put on the bear call spread, you want the market to go down, do you think it would be better for us to place a trade when the market is overbought, when the market is extended? Chances are the market probably is going up this way and then starting to come down. Well, do you want to place it down here, or do you want to place it when the market is already neutral, coming down, or has gone down much further where it's oversold? So chances are that we do only want to place it when it's overbought, because this gives us more chance that the market is overextended and then it will come back down. So that's key criteria number one. Now, key criteria number two is to place the bear call spread above a resistance level. So if you're not familiar what is a resistance level, this is what you call support and resistance. Basically, it's a place where the market has difficulty or trouble going above. So you will see in the chart, you notice that sometimes there'll be points where the market will suddenly just, you know, have difficulty going up. You notice at this point down here, you see the market has tested the level twice. After that, it has come back down. So we know that the market has placed this as a resistance level. That means the price has some difficulty going above this level. So the next time, if the market goes up here again, right, and then you see that the stochastic indicator, right, is indicating that the market is overbought, well, it indicates to us that there is a likelihood, a greater probability that the market might head down than it going up. Right, so what we want to do is we want to place this bear call spread, the short call, above this resistance line down here. And the reasons we want to place it above here is because there's a chance the market can still go up, right? It may go up, then after that, once it hits this level, there's a chance that it will find difficulty and then you go back down. So that's how we make the money on our bear call spread. Now, if it doesn't go down, at least it will still find some difficulty. It will go back and forth down here. And by that time, because we have a credit spread on, which is a time decay kind of spread, right? As time goes past, we will still make money on a spread, even though, right, it doesn't go down. So that is why it's very important for us to identify this resistance level, right? So basically, it can be a previous high, or you can see that, you know, where prices has bounced a couple of times at the level and it doesn't goes up. So by placing the bear call spread above a resistance level, it decreases the chances of the market breaching the short leg of the bear call spread. So we have the short leg here, and then we have the long leg here. So we want to make it as difficult as possible for the market to reach this short strike of our bear call spread, because if it goes above here, that's where we're going to lose money at expiration. So with this resistance level, it sort of like puts up a barrier, right? A barrier where it makes it difficult for the price to go up. So that's key criteria number two. Now, key criteria number three is that the short leg of the bear call spread is roughly around 20 to 30 delta. Sometimes, you know, it can pass 30 deltas, maybe 35, 40 deltas. As long as you see that the setup is right, we have this two key criteria, we want to go ahead to place a trade. So now, while the definition of delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security, it can also be used as a rough estimate on the probability of profit. Right, so this is an important concept to understand when you're trading credit spreads such as this. So for example, a 30 delta would roughly be a 70% probability of profit, and a 20 delta would be roughly a 80% probability of profit. All right, so the key idea here down here is that if we want something that's above 70% profit, we can actually achieve that just by identifying the short strike delta. Right, so let's say if the short strike delta is 30 deltas, and then we have a 5-point wide or 10-point wide vertical spread or a bear call spread, we know that based on the mathematical formula, which is a complex formula, we already have a 70% probability of profit, right, roughly. And you can see this through the risk profile on your trading platform, right? I use Thinkorswim. You can go ahead and just see the risk profile. It will tell you what is your probability of profit. So imagine that you already have a 70% probability of profit by default just when you chose a 30 delta short strike on your bear call spread. Now, this does not include key criteria 1 and 2. What if we also include key criteria number 2 and key criteria number 1? Because right now, not only do you have the 70% probability of profit by default just through the deltas, now you have even, you placed it above a resistance level and you wait until the market is overbought. So now you have even more things in your favor that's going to work out for you. So that is why a 70% probability of profit is just the base POP which you're going to have, right? Probability of profits is POP, P-O-P. So if you're going to include these two other key criteria, you can have a higher probability of profit, which can help you get a much better positive expectancy. So if you remember the formula down here, you can have a higher than 71% if you put these key criteria together. All right, so ideally we also do not want to go lesser than 20 deltas because we may not get enough premium, all right, for the risk that we're taking on the spread. All right, so here are the 7 steps to a high probability bear call spread setup. So first of all, step number 1, we're going to wait until the stochastic oscillator is showing an overbought condition, right? So if the stochastic does not show an overbought condition, we just do not bother looking at any trades, right? We want all the odds in our favor. Make sure that this key criteria number 1 is there first, right? So we can go through all the charts. You go through chart number 1, chart number 2, chart number 3. If it's not overbought, don't bother about it. But when it's overbought, then you want to go on to the next steps. And ideally, we want this to be in a downtrend, right? Because in a downtrend, the market wants to basically go down, right? So ideally, we want to look for the overbought condition in a downtrend. That means the market is going down, right? It's making higher highs, making lower highs, lower lows. And at this point, maybe you see that the market is in an overbought condition at this point, right? You have the indicator, maybe the line is over down here and it's overbought. So this is a very good area, right, for us to identify a bear call spread. So next, you want to identify the previous resistance level, which is the previous high. So in this case, we identify it is here. All right, so once you identify the resistance level, right, let's take a look at the option chain, and then you want to go to around 30 to 60 DTEs. That's the ideal number for me, right? Some people like to go for the weekly ones. For me, I feel that the weekly is a bit short because the problem with the weekly options is that you may not be able to get the right delta that is above the resistance level. Because if you're going to have a weekly option, chances are that 30 deltas is going to be much closer to the market, right? If you go for 3060, you may be able to get a strike that's above this resistance level, which is what we want, right? So that's step number 4. We want to find a strike that's above the previous resistance level. And then step number 5, see if the strike is within 20 to 30 deltas. If it's not, wait till the market goes higher. So let's say, for example, if it's down here, you cannot get a strike, you know, down here there's 20 to 30 deltas, maybe it's only 5 deltas. Then you want to wait for the market to go a little bit higher first before identifying your bear call spread, right? Step number 6, if the strike is within 20-30 deltas, you want to construct your bear call spread and see if you can at least get $1 to $1.50 premium for a 5-point wide spread, or at least $2 to $3 premium for a 10-point wide spread. Finally, if you're satisfied with the premium received, let's place a trade and manage the trade accordingly. Alright, so now I'll share with you some examples so you know exactly what to look out for in your chart and how to construct this. By the way, if this video has been helpful to you so far, I greatly appreciate if you hit the thumbs up button, and also please subscribe to my channel so I can create more videos like this for you in the future. Alright, back to the video. Okay, so the very first example for our bear call spread is Nike, right? NKE ticker symbol. So as you can see right here on this chart, the very first thing that we want to look out for is this signal down here. Overbought. Right now it's over the line, it's overbought, it has fulfilled key criteria number 1. So what is key criteria number 2? We want to look for the previous highs or the resistance level. So what I did is I just drew a line down here to identify the previous resistance level. So as you can see, there are 2 resistance levels above where the current price is right now. So one is at 118.42, the other one is 123. You can see that the market actually gapped up after earnings. So the moment it gapped up, okay, there's a pretty big gap. The market started to go sideways, and it's clearly overbought down here. So this can be a very good chance for us to place a bear call spread, because there is a chance that the market will come down to fill the gap, right? So the next step is that we want to pull out our option chain and take a look at our strikes to see whether we can construct our bear call spread and get the credit which we want. So the very first one that we want to take a look at, right, since we are at around 117 at the market price, so we might want to look at either 120 or 125. Ideally you want 125 because it is above the previous high down here. Right, this looks like a very good point. Right now it is testing this other high down here. If you want to be more aggressive, then you can go for something around above 118, around maybe 120. If you're more conservative, then you go for above this previous resistance. So this way there is actually 2 barriers for it to pass through before you can actually lose money at expiration, right? So I would go for the 125 ideally if there is the premium which we can receive. So first off, you want to start off with the aggressive one. As you can see, the aggressive one 120 and then 125. What we get is $1.88. So for a $5 wide spread, we want to get anywhere from $1 to $1.50. So as you can see, it is very good credit for us down here. So we can definitely go with this if you're aggressive. Now let's take a look at the more conservative one, which is 125, which is above down here. Let's see if we can get a credit which we want. So as you can see, 125, 130, it gives us a credit of $1.18, which is much lesser than this, but it is still around within our credit which we want, which is $1 to $1.50. So we can definitely go ahead with this trade if you want to go with it. So this is how you identify whether you can place the trade on or not. Now if you find that $1.18 is a little bit too little, let's say you want slightly more, let's say you want $1.50, you can go ahead and actually place a limit order for $1.50. This way you can wait until if the market does go up a little bit, then you could get filled on $1.50 as well. So this way you do not have to always be staring at the market. You can always place a limit order, and that is basically what I always do. Alright, example number 2. Example number 2 is our index ETFs, SPY. So as you can see down here, the market is in a downtrend. You can see it's making lower lows, lower highs, lower lows. And then we have at the right hand corner, we have where the market is overbought. At the same time, we have what you call a dynamic resistance level, right? A dynamic resistance level is by this moving average down here, right? Moving average can serve as a dynamic resistance level as well. As you can see down here, the price has touched this moving average and then it came back down. So we know that this line can serve as a dynamic resistance level, but a stronger level will always be price levels. All right, so I would rather go for this level and this level, and it would be best if this can coincide with this level as well. All right, so now that we see that the market is overbought, this is a valid key criteria number 1. Let's go on to find key criteria number 2, and that is to draw a line on the previous high, right, the resistance level down here. So we can see that it's 411. Now there's another resistance level down here which is above 430, but we know that it's a little bit too far from the current market price, and we know that there is no way we can get a bear call spread construct, right, with the credit which we want at 430, because it's just too far away. So at the moment right now we can only go for 411. So let's take a look at what we can construct. So we'll pull out the option chain, and then we'll take a look and see what is the strike that we can get that is above 411. Now generally I like to start off with round numbers, right? So like 415, 420, 430, these are nice numbers for me to go on, right? Especially, since they are a few points above the actual resistance point. So I hesitate or rarely go for any points or any bear call spread that's like 412, 413, those kind. But you could if you want to, right? So for me, I like to go for 415. So I'll just take a look and see whether I can construct one and get the credit which I want. So as you can see, I went for the 415, 420, and you can see it's only 92 cents. Right, you cannot get $1 for this. So chances are there is no go for me for this bear call spread. I may just place a limit order. I'll probably place around $1.25 or maybe $1.50, hoping that the market will go up first, touch this line, get me filled, and then come back down. Right? So if you're a little bit more aggressive and you think that the market is probably going to go down because you see this candlestick is a bearish candlestick structure, right? And you see the market is really overbought, you want to get in now, you could be a little bit more aggressive. You go for the 412. So I'll construct the 412 for you. So as you can see, 412, 417, you get $1.04, which meets our minimum criteria of $1 credit spread, right? $1 in terms of premium. So you can go for this if you do want to. All right, so that's for example number 2. All right, example number 3 is also on SPY. So as you can see, weeks have passed since the date. All right, since this price, as you can see on the previous chart, it was at this point at around 382. So this is just the continuation. So if you had waited until a few weeks has gone, you notice that you would be able to have another opportunity, or you would have your trades placed if you had placed for a higher credit, right? So at this point, you can see the market is overbought again. So now that it's overbought again, now you can see we have our previous resistance level. So what we want to do is bring up our option chain again, and let's see what kind of a bear call spread we can construct for this. So for this, I'll go for either the 415 or 420. Now that the market has gone slightly higher, we can even try for the 420. So let's start off with the 415, somewhere around here, and let's see what kind of credit we can get. So you can see with the 415, 420, we can get $1.44. So this is a green light for us to place the bear call spread. I generally like whole numbers, so I will place a limit order to go for $1.50, or maybe even $1.75, something like that. Now let's take a look at $420, the bear call spread, 420 and 425. So this way you're even more conservative, and we can get $1.11. So again, this is a green light for us to place the bear call spread. Again, if you don't like this credit, you can go for a limit order, go for $1.25, $1.50, wherever you feel comfortable with for the credit. Alright, so as you can see, if you fast forward it, you can see that the market did have some difficulties going above this resistance level. You can see it never once touched it. It tried twice and then it went back down. So even in example number 2, remember where the market was somewhere around here. And even though if you place the short strike at 412, guess what? You would have still been profitable on this trade, because even though the market went up, it never did go above our previous resistance level, this previous high. So that is why it is very important for us to find these resistance levels, because it is levels where it's telling us that there's a good chance the market can come back down again. So if you have placed any of the trades, right, either you placed here or you waited for the market to go a little bit higher before you place your bear call spread, whether it's 412, 415, 420, it's all going to be profitable, right? So that is why you want to use all these three criteria that I've given you to your advantage. Put the odds in your favor, then you can place the trade, and that's how you can always get a good win rate to get a positive expectancy in the long run for your bear call spread. Alright guys, so that's it for this video. I hope you found this video helpful. If you have, I appreciate if you give me a thumbs up, and also subscribe to my channel as well, so I can always create these videos for you. And as always, thank you for watching. I appreciate your time, and may the options favor you.